The term CapEx, which stands for capital expenditure, is a word that refers to the money a company spends on purchasing capital goods. When companies invest in new equipment or software, they are said to invest it in CapEx. While this may seem like just another boring accounting term, there's a lot more to it than meets the eye. In this video, we'll discuss what CapEx is and why you should care about it. If you want to know more tips like this, subscribe for weekly videos and turn on the notification bell so you are informed first. What is capital expenditure? Capital expenditures are a type of expenditure that a business makes to improve its long-term assets, efficiency, or capacity. Long-term assets are generally physical, fixed, and non-replenishable assets with a useful life of more than one accounting period, such as property, equipment, or infrastructure. Capital expenditures are also known as CapEx or capital expenses. Capital expenditures include things like new equipment, machinery, land, plant, buildings, warehouse, furnishings and fixtures, company cars, software and intangible assets such as patents and licenses. The cash flow statement shows how much money an organization spends in a given period. Capital expenditures have the potential to significantly influence an organization's short and long-term financial health. As a result, making wise CapEx decisions is critical to a company's financial health. Many firms strive to keep their historic capital expenditure levels high in order to reassure investors that the company's management is still investing in the company's growth. Types of capital expenditure. The two most typical forms of business investment are 1. Expenditures to maintain current operational levels, and 2. Expenditures to allow for future growth. Capital expenditure can be physical, such as machine, or abstract, such as patent. Both intangible and real capital investments are generally regarded as assets since they may be sold when needed. It's crucial to remember that expenditures on maintenance or continuing basic maintenance of assets are not considered capital expenditure and should be recorded as a repair and maintenance costs on the income statement. Importance of CapEx. Capital expenditures are often crucial decisions for businesses. They're essential because of the following reasons. Long-term effects. Capital investment choices have an extended influence on the future. The current state of production or manufacturing is primarily a consequence of past capital investments. Similarly, the company's present capital expenditures decisions will have a significant influence on its future operations. Capital expenditure decisions drive the company's development. Before authorizing capital expenditures, a business's long-term strategic goals and budgeting process must be in place. Irreversibility. Capital expenditures are frequently difficult to reverse without the firm incurring losses. Most types of capital expenditure are designed to fulfill certain business needs and demands. Used capital equipment is a rather challenging market to break into. Depreciation. Capital expenditures produce an increase in asset accounts for a company. However, once capital assets are put into use, depreciation sets in, and they lose value over their useful life. Initial costs are high. Capital expenditures are generally rather costly, especially for firms in industries such as manufacturing, telecom, utilities, and oil exploration. Investing in tangible assets such as facilities, equipment, or real estate can deliver long-term advantages, but will require a significant financial outlay upfront, far more than operational expenditures. Capital expenses tend to climb over time as technology improves. The challenges with CapEx. Despite the fact that capital expenditure choices are critical, they add to the complexity of project management. Estimation problems. The accounting process of determining, measuring, and estimating capital expenditures may be time-consuming. This is especially true in the case of short-term expenditures. Unpredictable. Large investments in capital assets is made by businesses to obtain predetermined results. However, such outcomes are not guaranteed and losses may occur. Capital expenditure choices generally contain a lot of uncertainty in terms of cost and benefit. Even the most skilled forecasters occasionally make mistakes. Organizations must account for risk to reduce possible losses, even though it's impossible to eliminate them during financial planning. Temporal spread. The costs and benefits of a capital expenditure is usually paid over a long period of time. This can lead to problems with estimating the discount rate and establishing equivalence. Capital expenditure budgeting practices that are effective. When things go wrong, major infrastructure projects that require significant amounts of money, as well as capital expenditures, can quickly get out of hand and result in organizations spending lots of money. Not if you plan well, have the correct tools, and excellent project management. But this isn't always the case. Here are some ways to make capital expenditure budgeting more effective. Establish a structure at the start. Before we can start a project, you need to make adequate preparations. If they aren't planned properly, they may get out of hand. You must first identify the project's scope, establish realistic deadlines, and ensure that the entire plan is reviewed and approved before starting the project. It's at this point that you should consider how many internal resources will be required by the project, including manpower, supplies, finances, and services. To get a more accurate estimate, include more information in the project. Adopt a long-term mindset. What if you're in the midst of a capital expenditure project and need to decide whether to borrow money or save funds for it? Typically, saving money for an item's purchase implies that you'll have to wait a while before receiving it. However, taking out a loan has the potential to increase your debt and put your future borrowing capacity at risk. Both alternatives might be beneficial to your company, and different options may be required for various initiatives. Use reliable software for the budget. Choose a reliable and practical budgeting software from the start. The degree of the project, the speed of the program, and the danger of error will influence your selection. Properly utilize the software to figure out how much money you'll need for different projects. Then, determine which items are required by your business and what is needed to accomplish the project's objectives. Find a balance between each of the factors so that expenses can be controlled without compromising effectiveness or efficiency. Accurate data is required. Accurate data is critical for managing capital projects effectively. To develop a realistic budget and generate useful reports, you need to have the correct information. Balance the detail. Trying to go into too much detail may result in a lot of time being spent gathering data, which could make the budget outdated by the time it's completed. However, if there is not enough information, the budget will be vague and therefore less helpful. The optimum balance must be discovered through trial and error. Form clear policies to help you. Because managing capital expenditure in a large company may require the participation of numerous people, divisions, or even countries, clear rules should be established to keep the budget on track. What CapEx can tell you. The term CapEx has a wide meaning in the business world, signifying all types of expenditures incurred to keep or develop a firm. To put it another way, CapEx is any kind of expenditure that appears on a company's balance sheet rather than on its income statement as an expense. Capitalizing an asset entails spreading the cost of the purchase over its useful life. The amount of capital expenditures a firm is likely to make is determined by the industry. Oil exploration and production, telecoms, manufacturing, and utility businesses have the greatest amounts of capital expenditures. CapEx is the amount of money a firm spends on new assets and operations. It's important to note that each of these terms has a different meaning and may be used interchangeably, so you'll want to look up the precise definitions for each one. The sum of all expenditures made in order to produce or improve things such as buildings or equipment is a company's capital expenditures. Most budgets include both operational and capital expenditure costs, as well as non-monetary expenses such as time or labour costs. In general terms, the total amount of money spent by a business over a certain period can be referred to as its expenses. There are many ways to calculate capital expenditures. A good way is to look on the company's income statement and find the amount of depreciation expense for this period. On their balance sheet, you will see a line item called Property, Plant and Equipment, PP&E. That is the current period's PP&E balance. What you need to know. Capital expenditures are the money used to buy, improve and extend the life of fixed assets. These include things like property, equipment and infrastructure. Capital expenditures usually take two forms: acquisition expenditures and expansion expenditures. Capital expenditures are very important because they cost a lot of money. They're also permanent, so you have to think about them carefully. You need to plan for them well and spend your money wisely.